Today, not 2008 again, but a crisis nevertheless. Hello again, it's Martin North from Digital Finance Analytics, our latest post covering finance and property news. Well, the wrongly named global financial crisis of 2007 onwards is probably the pivotal professional experience for most people now working in finance. So the question is, are we here again then? Well, my view is that despite the fire sale of First Republic over the weekend, confidence in regional banking is weakening, and there was yet more selling of their shares on Thursday. A new wave of turmoil in regional banks has disrupted trading desks worldwide, leading traders to increase their bets on Federal Reserve interest rate cuts due to growing concerns about their next financial crisis. Recent trading halts within the financial sector have impacted Western Alliance Bank Corporation and PacWest Bancorp, both experiencing losses exceeding 60% for each stock. This turmoil has spread across various other bank institutions, large and small alike, such as First Horizon National Corporation, which saw a decline of over 30% after its planned merger with Toronto Dominion Bank fell through, and additionally, an investigation to Goldman Sachs' involvement in SVB Financial Group deal contributed to the negative market sentiment. All shares within the Invesco KBW Bank ETF, which consists of financial giants like JP Morgan Chase and Bank of America Corporation, retreated during the period, and the $2.5 billion SPDR S&P Regional Banking Exchange Traded Fund experienced its lowest closing since October 2020. As a result, this unrest among banks restrained overall market growth and caused the S&P 500 to suffer its fourth consecutive decline. And the volatility index, the fear gauge, spiked significantly during this time. It's reaching a critical level of 20 points now, contrasting sharply to April's relatively calm levels of around 16 points, although as I discussed recently, actually these options are less relevant than previous. Now, this ongoing instability highlights how fragile investor confidence remains, despite Fed Chair Jerome Powell's assurances on Wednesday that authorities are closer than ever to containing the crisis. Smaller lenders find themselves under increasing pressure following a year where rate hikes severely affected their bond holdings values and drove unrealized losses up to an estimated $1.84 trillion in the US alone. Krishna Guha, Vice Chairman of Evercore ISI, warned that the acute phase of bank turmoil may not be over, and policymakers need urgently to recognise that. And he added the problem is that their financial stability policy options are very limited. The renewed speculation against one name after another is indeed reminiscent of 2008, but it's dangerous to view everything through the lens of 2008 because it's possible for a crisis to do serious damage while taking a different form and not being quite as severe, but their valuation is almost back to the Slav Despond and the global financial crisis, while the relative performance of the regional banks compared to the market as a whole have plumbed those new depths. Now, this is not just affecting the smaller lenders, but it's also taken big bites out of the market cap of some of the largest banking groups that lie outside the special regulatory category of those deemed to be too big to fail. Banking is still a game of confidence, and when the chips are down, money and sentiment can move quickly, and these days it's amplified by the digital environment and social networks. That said, there are some important differences, as this time things don't seem to hinge on distrust in the valuations of assets on banks' books or the question of whether their loans are toxic. Rather, the issue now concentrates on profits. With interest rates where they are, the logic is that banks can only hold on to their deposits, a vital source of cheap funding, of course, by offering rates to customers that obliterate their profits. This doesn't directly threaten the bank in the way that the bad loans did back in 2008, but if a bank looks less likely to make profits, That means a lower share price, which in turn will make it harder for them to raise equity funding, not just debt financing. And allowing for consolidation in the banking sector is a possibility, but it would be painful for regulators and for consumers that would only get worse service and value for money from monopolistic monoliths. So it's actually getting harder to resist this, though, given what we're seeing. This could lead to credit tightening, and it could force changes in both monetary and fiscal policy. Yields have fallen again this week on the belief that the banking crisis will compel the Fed to ease monetary policy. But there's another factor too. It's actually perhaps even more important and more obvious. This could involve a big fiscal outlay, insuring all deposits, advocated by many as a measure that could end the crisis. That would be mighty costly, of course, even on an interim basis. And to do it on a permanent basis, it would require legislation, which in turn would require America's polarized politicians to agree on something, which would be quite a first. Now, this is very different in concept then from what happened in 2008, and the problem is one of liquidity, or the bank's ability to raise money in a hurry rather than solvency. So it might be less serious, but markets are still haunted by it. And these changed market dynamics are making banks think very differently. For example, as the AFR highlighted, Macquarie and ANZ, two of the most aggressive banks in the mortgage market in Australia, say they're producing better returns deploying capital offshore as competition crimps profits in domestic housing lending. In separate presentations on Friday, both pointed to the diversification as a key advantage. ANZ highlighted more attractive opportunities abroad compared to funding new home loans in Australia, which bankers say are being written close to the cost of capital amid a wave of refinancing. ANZ, of course, withdrew dramatically from international markets over the last few years, focusing on the domestic market. Well, they seem to be now wanting to turn that around. And Macquarie, meanwhile, signalled on Friday that it slowed growth in housing lending in the 6 months to March 31, after snaring 5% of the overall market for both loans and deposits from its largest rivals. It said it would only write new business which delivers strong returns and would not be paying cashbacks to borrowers like the major banks are doing. With investors fretting that the mortgage war is damaging margins at the big banks, which are simultaneously being squeezed by intensifying competition for funding via deposits, ANZ's boss Shane Elliott said returns from home loans were certainly not attractive as they used to be. The world we're operating today is competitively more intense than ever, he said, after releasing a record interim cash profit of $3.82 billion, with ANZ's commercial, institutional and New Zealand divisions growing profits at a faster rate than the retail bank in Australia. Since rates started rising, it's been extraordinarily competitive in Australian home loans. Some would argue we're potentially at break even. Now that is being mirrored by intense competition in deposits. Home loans used to be written at returns on equity of between 15 and 20%, but analysts reckon that those have fallen to about 6% as banks offer steep discounts and cashbacks as the level of refinancing in the market reached a record monthly high of $21.2 billion in March. In comparison, Mr. Elliott said ANZ's return on equity in its institutional bank, which supports large corporates, was at the lower end of the mid-teens. And that will see ANZ put more capital into opportunities offshore, a complete reversal, of course, from a few years ago. What has changed fundamentally is the stack rank of returns for many years was set with institution at the bottom and Australian housing at the top, he said. That has massively flipped. The big question is this a semi-permanent shift or is it transitory? And the jury is still out, of course. We're going to be allocating more capital institution, though, they said. At Macquarie, which also reported a record profit for its full year of $5.18 billion. It was driven by its commodity units, its chief executive said, and its retail bank had slowed growth in the 6 months to the end of March as the housing market stalled and returns dwindled. We're keen to grow, but only on the right terms where it can be disciplined, high-quality growth. We want good returns for our shareholders. Macquarie's chief financial officer, Alex Harvey, told analysts that it had slowed growth in mortgage lending as the gap between the cost of deposits and wholesale funding had started to close. Savers have been getting more savvy, switching into term deposits with higher rates, while many mortgage customers are coming off fixed rates and now shopping around. Macquarie stresses digital bank continues to attract new customers and will continue to grow, albeit at a slower rate. And Mr. Harvey said Macquarie would not offer cashbacks because we want to make a sensible return for the risk we're taking on in the capital we're deploying. Elliott said the realities for the competitive environment may have become more apparent to Macquarie recently. They are the fifth big bank now and are the fastest growing, he said. But what is interesting is it would appear they have to be slamming on the brakes on home lending, which may indicate that they've woken up to the margin outcomes that are really tough and maybe they're being a bit more cautious. ANZ said that it would need to stay in the mortgage game, which remains a big contributor to the group, but it's looking to cut the cost of distribution through a lower cost digital platform it calls ANZ Plus. Over the 6 months to the end of March, ANZ's home loan book grew by 4% to $295 billion, while the cash profit on its retail bank was up 9% over the past 12 months, and it fell 4% though compared to the second half. There's going to be a natural slowing in the mortgage market in the front book just because of less transactional activity in the market, said Milford Asset Management Portfolio Manager Jason Karangai. We feel there's going to be a lot more customers staying with existing banks for a magnitude of reasons. And T. Rowe Price investment analyst Nick Vidal said that ANZ and Macquarie results on Friday and National Australia's banks' disappointing numbers on Thursday revealed all banks are experiencing margin pressure from increased competition, including those pulling back on growth. The market will need to reduce margin expectations for all the banks. Competition has been higher than expected and banks will not claw that back, Vidal said. Banks are being attracted to domestic deposits as offshore funding markets remain volatile following global banking collapses, which Mr. Elliott said would continue, suggesting risk even for institutional banking and its market divisions will remain elevated. Many commentators suggested that the issues confronting Silicon Valley Bank and Credit Suisse are isolated, but I am not so sure, he said. When considering global interest rates, it's hard to go from 0 to 100 in record time and expect limited casualties. There may be more turmoil to come, as we've seen this week with First Republic Bank, and while it is easy to dismiss this as happening somewhere else in a hyper-connected world, what happens elsewhere impacts us faster than ever. We would expect to see ongoing distress globally in financials, commercial property, construction, and related supply chains. So the point here is that whilst it may be true that we are not in 2008 territory once again, the real situation could be quite concerning. And frankly, nobody quite knows how far and deep the pressure on banks are with the massive swing in interest rates. We know that margins are under pressure. We know that the battle to get deposits means some are paying a lot more. And we also know that some are beginning to dial back their lending. And to me, the credit crunch coming is probably the most underestimated factor in all of this and could absolutely change the dynamics of bank profitability, not just over the next few months, but over the next few years. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.